There was a time, not long ago, when the housing market felt unstoppable. Prices climbed higher every month. Bidding wars became normal. Homes sold in days, sometimes hours. And people started to believe something dangerous. That it would never end. It didn't feel like a bubble. It felt like a new reality. Low interest rates, easy money, and a wave of buyers flooding the market created a powerful illusion, one where risks seemed to disappear. But history has a way of repeating itself. Quietly, patiently, and without warning. If you rewind the clock, you'll notice something familiar. In the early 2000s, before the crash of 2008, the same patterns were already forming. Rapid price growth, speculative buying, a belief that housing only goes up. Back then, the system was driven by subprime lending and financial engineering. This time, it looked different. But the outcome, it may not be so different after all. So what changed? Or more importantly, what didn't? After the global crisis of 2008, central banks stepped in aggressively. Interest rates were pushed to historic lows. Liquidity flooded the system. Borrowing became cheap, almost too cheap. This wasn't accidental. It was strategic. The goal was simple: stimulate growth, rebuild confidence, and keep the economy moving. And for years, it worked. But every action has a consequence. And in this case, the consequence was hidden in plain sight. As rates stayed low for longer than expected, a new generation of buyers entered the market. Millennials, once delayed by debt and economic uncertainty, began buying homes in large numbers. At the same time, institutional investors saw an opportunity. Single-family homes were no longer just places to live. They became assets. Entire neighborhoods were being purchased not by families, but by corporations. Quietly, strategically, relentlessly. This shift changed the market dynamics. Demand wasn't just emotional anymore. It was financial, calculated, and highly competitive. Then came 2020. The world stopped. But something strange happened. Instead of collapsing, the housing market surged. Record low interest rates, combined with pandemic-driven migration, created a perfect storm. People left crowded cities. They searched for space, affordability, freedom, and they were willing to pay for it. Prices didn't just rise. They exploded. In some regions, home values increased by over 30% in a single year. That kind of growth isn't normal. It's not sustainable. But in the moment, it felt justified. Because everyone had a reason. Low rates, remote work, limited supply. Each factor reinforced the belief that the market was strong, healthy, even invincible. But beneath the surface, pressure was building. Construction couldn't keep up with demand. Supply chains were breaking down. Labor shortages slowed new development. And inventory remained critically low. This imbalance created urgency. Buyers rushed in, afraid of missing out. Sellers held back, expecting even higher prices. And the market overheated. Then came the turning point. Subtle at first, almost invisible. Inflation. As prices across the economy began to rise, central banks were forced to act. Interest rates, which had stayed low for years, started climbing. Slowly, then faster. And that's when everything changed. Higher rates mean higher mortgage costs. Higher costs mean fewer qualified buyers. And fewer buyers mean less demand. But here's the critical part most people missed. Housing doesn't crash overnight. It shifts quietly, gradually, until suddenly everyone notices. At first, it was small signs. Homes staying on the market a little longer. Price cuts appearing more frequently. Bidding wars becoming less intense. Then, the psychology began to shift. Buyers became cautious. Sellers became uncertain. And the confidence that once drove the market started to fade. Because real estate isn't just numbers. It's emotion, expectation, belief. And when belief changes, everything changes. So the question is, was this just a correction, or the beginning of something bigger? Because if history has taught us anything, it's this: booms don't last forever. And when they end, they rarely end quietly. At first, it didn't look like a collapse. There were no dramatic headlines, no sudden panic, just silence. The kind of silence that only appears when something important is changing. The market didn't fall. It hesitated. Homes that once sold in days now sat for weeks, then months. Sellers noticed first, but they didn't react right away, because just months earlier, they had seen their neighbors sell at record prices. And so they waited. They priced their homes based on yesterday's market, not today's reality. This created a gap, a dangerous one. Buyers were pulling back. Sellers were holding firm. And between them, transactions began to slow. This is how a housing slowdown really begins. Not with fear, but with disagreement. At the same time, another shift was unfolding, one that most people didn't fully understand. Mortgage rates had crossed a psychological threshold. For years, buyers had grown used to cheap money. 3%, even lower in some cases. It felt normal, expected. But now, rates were doubling, in some cases tripling. And that changed everything. A home that felt affordable 6 months ago suddenly was. Monthly payments surged, budgets tightened, and buyers started stepping away. Not because they didn't want to buy, but because they couldn't justify the cost anymore. This wasn't emotional. It was mathematical. And math doesn't negotiate. As demand weakened, inventory slowly began to rise. At first, it looked like a positive sign. More listings meant more choices, more balance. But underneath, it signaled something deeper. Supply wasn't increasing because of new construction. It was increasing because homes weren't selling. That distinction matters. Because when inventory rises in a falling demand environment, prices don't stay stable. They bend. Then they drop. But again, not all at once. The first signs appeared in specific cities. Not everywhere. Not simultaneously. Markets that had surged the fastest during the boom were now the most vulnerable. Cities that saw massive inbound migration, rapid price spikes, investor-driven demand, places where growth had been aggressive. In these markets, price cuts became more frequent. 5%, 10%, sometimes more. Sellers who once held all the power were now negotiating. Concessions returned. Closing cost assistance, Rate buy-downs, repair credits, things that had disappeared during the boom, quietly came back. And yet, many still believed this was temporary. A short correction, a healthy adjustment, a pause before the next rise. But beneath that optimism, the data told a different story. Affordability had reached historic lows. Even as prices softened in some areas, higher interest rates kept monthly payments elevated. This created a trap. Prices weren't high enough to sustain seller expectations, but they weren't low enough to restore buyer demand. A market stuck in between. And in that space, activity slows dramatically. This is where momentum breaks, because real estate depends on movement, transactions, confidence, participation. Without those, the system stalls. Then came another layer of pressure. Investors. During the boom, institutional buyers had played a major role. They purchased homes at scale, rented them out, held them as long-term assets. But rising rates changed their calculations too. Higher financing costs, slowing rent growth, falling home values. Suddenly, the numbers didn't look as attractive. And when investors pull back, liquidity disappears. In some cases, they didn't just stop buying. They started selling. Not aggressively, not all at once, but enough to matter. Because unlike individual homeowners, investors act based on strategy, not emotion. And when the strategy shifts, so does the market. Meanwhile, home builders faced a different challenge. They had ramped up construction during the boom, trying to meet demand, trying to capture profit. But now, that demand was fading. Projects that made sense a year ago no longer penciled out. So they adjusted. New construction slowed. Incentives increased. Prices were cut quietly to move inventory. And yet, the broader market still resisted the idea of a downturn. Because the memory of the boom was still fresh. People anchored to peak prices, peak demand, peak confidence. But markets don't operate on memory. They operate on current conditions. And those conditions were changing fast. The most telling sign wasn't price drops. Not yet. It was time. Time on market increasing. Time between offers. Time it took for sellers to accept reality. Because in every housing cycle, time is the first signal. Prices are the second. And by the time prices begin to fall noticeably, the shift is already well underway. So the question becomes, where does it break first? Because not all markets are equal. Some have strong fundamentals, stable demand, balanced growth. Others were built on momentum, speculation, and rapid expansion. And when conditions tighten, those are the markets that feel it first. The early cracks don't appear everywhere. They appear where the pressure is highest. And once they start, they don't stay contained. They spread quietly, then all at once. By the time most people notice a downturn, it's already in motion. The headlines arrive late. The data confirms it later. But the Arabic alif, Arabic lam, Arabic het, Arabic kaf, Arabic yet, Arabic kaf, Arabic tet mabuta on the ground, that shows up first in specific places. Because a housing decline doesn't hit everywhere equally. It starts in pockets. Then it spreads. The first markets to feel it are usually the ones that rose the fastest. Cities that experienced explosive growth during the boom years. Places where prices didn't just climb. They accelerated. These were markets fueled by migration, by remote work, by a sudden shift in lifestyle priorities. People left expensive urban centers and rushed into what felt like more affordable alternatives. At the time, it made perfect sense. More space, lower costs, a better quality of life. But that wave of demand was never guaranteed to last. And when it slowed, those same markets became exposed. Take the so-called boomtowns, cities that saw massive population inflows in a short period. Developers rushed in. Investors followed. Prices surged. But when demand cooled, supply didn't disappear. It stayed. And that's where the begins. Because housing markets are highly sensitive to imbalance. Even a small shift in demand can have an outsized impact on prices. In some of these cities, inventory started rising rapidly. Not gradually, not slowly, but noticeably. Listings piled up. Price reductions became common. And sellers began competing with each other. That's a critical turning point. Because during the boom, buyers competed. Now, sellers do. And when sellers compete, prices move in one direction. Down. But not all declines look dramatic. Some are subtle. A home listed at $500,000 quietly drops to $475,000. Then $450,000. Each cut feels small. Justified. Temporary. But collectively, they tell a different story. A story of weakening demand. At the same time, another shift was happening beneath the surface. Migration patterns were changing. The pandemic-driven relocation wave began to slow. Some companies called workers back. Others adopted hybrid models. Suddenly, location mattered again. And the urgency to move. It faded. That left certain markets overextended, built for a level of demand that no longer existed. Meanwhile, affordability pressures continued to build, even in cities where prices had started to fall. Higher interest rates kept monthly payments elevated, so buyers stayed cautious. They waited. And in housing, waiting changes everything. Because when buyers step back, momentum disappears. And without momentum, prices don't just stabilize. They drift. Then there's the role of psychology. During the boom, fear of missing out drove decisions. Buy now or be priced out forever. That belief pushed people to act quickly, sometimes irrationally. But now, the psychology has flipped. Fear is still present, but it's different. Now it's, what if prices fall further? What if I overpay? What if this isn't the bottom? And that kind of fear slows markets down dramatically because hesitation spreads. One cautious buyer becomes 10. 10 become hundreds. And suddenly, demand doesn't just weaken. It evaporates. This is where the narrative begins to change. At first, it's framed as a slowdown, then a correction. But in certain markets, the shifts, decline, drop, downturn, and eventually something more serious. But here, what makes this phase different from the past? This isn't driven by reckless lending. Not in the same way as before. Borrowers today are, on average, more qualified. Credit standards are tighter. So the pressure doesn't come from defaults. At least not immediately. It comes from affordability. From demand destruction. From a system that expanded too quickly. And is now adjusting. And adjustments in housing are rarely smooth. They ripple from sellers to buyers, from investors to builders, from one city to the next. Because markets are connected. What happens in one region influences another. Confidence is contagious, but so is uncertainty. And as more cities begin to show signs of weakness, the narrative spreads. Buyers become even more cautious. Lenders become more selective. Investors become more defensive. And that's when the slowdown starts to feel like something else. Something heavier. Something harder to reverse. Because by this point, it's no longer just about prices. It's about trust. Trust in the market. Trust in timing. Trust in the idea that buying now still makes sense. And once that trust is shaken, recovery doesn't happen quickly. It takes time. Sometimes years. So now the question is the market slowing? That part is already clear. The real question is, how far does it go? Because if these trends continue, if demand remains weak, if inventory keeps rising, then this isn't just a localized decline. It becomes systemic. And when that happens, the impact reaches far beyond housing. By the time a housing downturn becomes obvious, it's already too late to react. The early signals were there. Slowing demand, rising inventory, shifting psychology. But now, those signals begin to converge. This is where a slowdown becomes something heavier. Not a crash in the dramatic, overnight sense, but a drawn-out unwinding. Because housing doesn't collapse like the stock market. It erodes, month by month, listing by listing, price cut by price cut, until the pattern becomes undeniable. Sellers who once held firm begin to capitulate. At first, they resist. They wait. They hope the market will rebound. But time changes expectations. Mortgage payments continue. Holding costs add up. Opportunities elsewhere emerge. And eventually, reality sets in. Prices must adjust. Not to what the market was, but to what buyers can afford now. And that gap between expectation and affordability is where the significant declines happen. Because during the boom, prices were driven by momentum. But during the downturn, they are driven by necessity. Homes aren't priced based on optimism anymore. They're priced to sell. And that shift changes everything. Buyers regain leverage. They negotiate harder. They take more time. They walk away more easily. And sellers have fewer options. At the same time, distress begins to surface. Not immediately. Not everywhere. But gradually. Some homeowners who bought at peak prices find themselves in a difficult position. Their home value declines, but their mortgage remains the same. In extreme cases, they owe more than the home is worth. This is where the concept of negative equity returns. And while lending standards may be stronger than in the past, financial pressure still exists. Job changes, unexpected expenses, economic slowdowns. These factors don't need to be widespread to have an impact, because housing markets are influenced at the margins. A small increase in forced selling can shift supply significantly. And when supply rises in a weak demand environment, prices fall further. This creates a feedback loop. Lower prices reduce confidence. Lower confidence reduces demand. Reduced demand pushes prices even lower. A cycle, self-reinforcing, difficult to stop once it gains momentum. Meanwhile, the broader economy begins to feel the housing isn't just a sector. It's a foundation. It influences construction, banking, consumer spending, local economies. When housing slows, these areas slow too. Construction projects are delayed or cancelled. Jobs are affected. Spending becomes more cautious. And this is how a housing downturn extends beyond real estate. But here where perspective matters. Not every downturn becomes a crisis. The today are different in key ways. There isn't the same level of speculative lending. There isn't the same systemic fragility in financial institutions. But that doesn't mean the impact is small. It simply means the process is different. Slower, more controlled, but still significant. Because even without a sudden collapse, a prolonged decline reshapes the market. It resets expectations. For buyers, it creates opportunity, but only for those with patience, with liquidity, with the ability to wait. For sellers, it becomes a test of timing. Those who adjust early limit their losses. Those who wait too long often face the steepest declines. And for investors, it becomes a game of strategy. Some step back, preserving capital. Others step in, looking for value. Because every downturn eventually creates opportunity, but only after the finds stability. And stability doesn't come quickly. It arrives after the has processed reality, after a line with affordability, after confidence begins to rebuild. And that process takes time. So where does that leave us? At the end of a cycle that began with optimism, accelerated through opportunity, and is now adjusting through pressure. From boom to bust, not because of a single event, but because of a series of decisions. Low interest rates, high demand, limited supply, rising. Each step made sense at the time, but together they created imbalance. And imbalance always corrects. The question is never if, only how, and how far. Because history doesn't repeat exactly, but it often rhymes. And in housing, those patterns are hard to ignore. So as the market continues to adjust, one thing becomes clear. This wasn't just a boom. It was a phase. And now, we're in another. The housing market doesn't move randomly. It follows cycles. Predictable in structure, but unpredictable in timing. And those cycles influence everything. They shape wealth. They shift opportunities. They redefine risk. During the boom, it felt untouchable. Prices rising, demand surging, confidence unshaken. But that sense of permanence was always temporary, because no market, no matter how strong, is immune to change. And that's the real power of this cycle. It reminds us that markets are not controlled by emotion alone, nor by policy, nor by belief, but by a balance between affordability and demand, between supply and Arabic alif, Arabic lam, Arabic waw, Arabic kaf, Arabic ta, between expectation and reality. And when that balance breaks, the market adjusts relentlessly. That's what makes it feel untouchable. Not because it never falls, but because it always finds a way to reset, to correct, to continue. And for those who understand that, the cycle isn't something to fear. It's something to watch, to study, to prepare for. Because within every downturn, there are signals, and within those signals, there is opportunity. The question is, will you see it coming next time?